Global powers are locked in an arms race to build the first commercially viable quantum computers, turning this hardware into a critical national security priority. Washington is accelerating this race by actively pouring billions of dollars into the sector to ensure domestic superiority over foreign rivals. New legislative funding packages are now providing structural validation for the industry, signaling that the government is committed to the sector's long-term future. IonQ currently generates the highest revenue of any publicly traded pure-play quantum firm, ending the first quarter of 2026 with a $3.1 billion cash position, a reserve that dwarfs its closest rivals. This massive scale and capital advantage makes IonQ the definitive bellwether for the sector. When investors want to trade the quantum trend, this is the stock that dictates the momentum for the entire cohort. IonQ is pursuing a vertically integrated full-stack strategy, acquiring its own supply chains and domestic foundries to position itself as the sole provider of quantum hardware and software. This level of ambition has pushed the valuation to an extreme level, meaning the stock is currently priced for absolutely flawless execution in an unpredictable industry. The bull case is anchored by staggering numbers: 755% revenue growth, a $3 billion cash hoard, and aggressive recent buy-ins from institutional giants like Goldman Sachs. On the other side, the bear case highlights a $186 million EBITDA loss, a price-to-sales ratio over 100, consistent internal insider selling, and a notable exclusion from a major government funding round. We are going to cut through the retail hype and the short seller panic to determine exactly which investor should take on this specific risk profile. If you look at IonQ's recent headlines, you might see a reported GAAP net income of over $800 million and assume they're profitable. This chart shows the reality. The towering green bar is an accounting artifact driven by non-cash warrant revaluations, not real revenue. Remove those adjustments, and the red line shows a steep operational burn, an adjusted EBITDA loss of $186 million. To maintain their cash buffer, IonQ sold 16 million shares and issues millions more for acquisitions. Investors pay through continuous dilution. Buying in today means paying a 100 times revenue multiple for a business years away from profitability. IonQ's primary technical advantage is its trapped ion architecture. Using electromagnetic fields to hold charged particles, they achieve high-fidelity connectivity between any two system qubits. But the industry hasn't settled on a standard technology, and IonQ faces intense pressure from competing modalities like superconducting chips. To defend their market share, the company is positioning itself as a dedicated partner for U.S. defense and intelligence agencies. They have already secured over $100 million in contracts with agencies like DARPA, demonstrating real traction in the defense sector. However, that dominance isn't absolute. In May 2026, the Department of Commerce allocated $2 billion in CHIPS Act funding, and IonQ was the only major public player left off the list. This chart shows that while IonQ leads in revenue, competitors like D-Wave, Rigetti, and Quantinuum were the ones who actually secured the government's CHIPS Act validation this round. IonQ's scale is impressive, but their exclusion from this funding round proves they don't have a monopoly on government trust. This competition for validation is what drives the violent swings in market sentiment for IonQ's stock. Retail investors remain fiercely bullish, often dismissing short seller reports as opportunities to buy more shares for the long term. Institutions are following suit. Goldman Sachs nearly doubled its position in early 2026, and Amazon recently re-entered the stock after previously exiting. While the first two columns show strong external buying, the third column reveals a different internal story. Over the last 6 months, IonQ executives, including the CFO and Chief Revenue Officer, have been net sellers of the stock. This suggests that while retail and institutional interest provides a floor for the price, the people running the company aren't signaling that the shares are currently a bargain. IonQ offers the safest balance sheet in the sector, but its high valuation leaves no margin for error if their technology roadmap slips. For investors who believe in trapped ion technology but want to avoid IonQ's specific valuation risks, there is another way to play the sector. Quantinuum is the strongest direct proxy for IonQ's technology, utilizing the same ion trap architecture for its quantum systems. Unlike IonQ, Quantinuum is majority owned by Honeywell and actually secured a CHIPS Act letter of intent for up to $100 million. It functions as a strategic hedge, offering the same architectural upside with a more established institutional backing. Before you allocate capital, you have to ruthlessly evaluate which investment mandate you are actually following. If you are looking for high volatility upside and are comfortable with ongoing share dilution to fund growth, IonQ is the default vehicle for that trade. If you believe trapped ion technology will win, but you require more institutional safety and government validation, Quantinium is the more logical choice. And if you want mature go-to-market strategies that already have federal CHIPS validation in other technical modalities, look toward D-Wave or Rigetti. IonQ is currently priced for perfection. Investing today means accepting a massive premium for a technology that still has years of execution ahead.